Hello, and welcome to the View from Sibos 2020 video series. Obviously, the conference this year is being held virtually. I'm Joy McKnight, Managing Editor of The Banker, and I'm joined via video link by Stephanie Wolf, who's Head of Global Financial Institutions, Governments, and Business Banking, Global Transaction Services at Bank of America. Stephanie, thanks so much for joining me.
Thank you, Joy. Pleasure to be here.
So the pandemic is likely to go into 2021. What does that mean for the financial institution's treasury services business at Bank of America?
It means, first and foremost, everything we expected is no longer relevant. I feel as if we've thrown a deck of cards up in the air and they've landed, and now our job is to make sense of where they've landed. We are looking at much lower interest rates around the world. As much of what transaction banks do is manage liquidity, short-term liquidity, rate declines matter for us. They matter significantly. We have all been flooded with large amounts of cash, which our clients are leaving with us and trusting with us. Yet we can't necessarily use that cash to increase loan volume because loan volume has certainly changed. And we don't expect loan volume to be what it would have been. So that cash is sitting here at very low interest rates for an uncertain time period. That's issue number one. Issue number two is a positive. All things digital in every way, forever. So we have a situation where the only way you can interact is, for the most part, is digitally. Everyone remembers their passwords now. Everyone knows how to move money and information quickly, and for the vast majority, very, very securely. And we are looking at how do we move beyond the COVID period to eliminate paper, eliminate cash, eliminate checks, I just read an article that in Japan, the government is moving away from facsimile machines. Our junior analysts don't know what a facsimile machine even is or what a fax number is. So all things digital, and more so, all things mobile. We also have to grapple with the fact that volumes are down. Transaction volumes and value, it's more value than volume right now, is down. We don't expect trade to recover globally for months and months and months. And we're certainly seeing wire and ACH volume, low value volume, lower than it's been in years. One last thing we're struggling with is that our clients are struggling. And I should say we're struggling because it's our role to serve those clients. And when a client is struggling economically, when their own client base is dropping, when perhaps their industry is in more jeopardy than it was pre-pandemic, we have to come up with new and different ways to help them through this period while protecting our own bank's balance sheet. So it means changes for certain, some opportunities, digital, but certainly a landscape of risks.
So what actions have you taken from a risk perspective, in particular after the economic downturn?
I should graciously say I'm a seasoned banker. I've covered financial services companies for decades, and I have seen a few cycles before. And usually in a financial crisis, the financial services industry clients become much more volatile in terms of their performance. You usually see downgrades, and you see, sadly, some companies notwithstanding the crisis. So the first thing we do is look at all of our exposures. What are our short-term exposures to clients that may be at risk? And in this cycle, it's not financial services companies first and foremost, it's the travel and leisure industry, airlines, oil and gas was hit very early on. So we look at our exposures, both short-term, long-term. We look at our overdraft exposures, and we, for every exposure, consider where do we want to be during this uncertain time. For some clients, collateral is sought. One effort that we undertook at Bank of America, we looked at our commercial credit card limits. Clearly, our clients, including Bank of America, are not traveling as much as they used to. Should we have those limits as high as they were pre-pandemic, or should we bring them down a bit to reflect a new reality? So those are the kinds of actions we're taking on the risk side.
And what other risk initiatives are occurring in your group?
We continue with that effort to make sure that each and every year our clients meet all of our Know Your Client criteria. Those criteria are still changing in some places in the world. There may be a higher bar in some places in the world, and when we come back and look at that client, have to raise ourselves to a higher bar. But we're also actually moving toward greater automation. The use of the Wolfsburg due diligence questionnaire for correspondent banks has reduced the amount of work we will undertake in that particular population by a sizable amount. But that risk effort remains very much a part of our day-to-day lives. And then I would say something that's grown more important to me and my team of client-facing professionals around the world is transaction monitoring. So we all know it took place. It was sort of behind the curtain, and it was done via automated processes and procedures. Well, we're getting much more sophisticated in our transaction monitoring because money is flowing in different ways. We look at some of the e-wallets, some of the e-marketplaces, some, especially now during this time, some of the charitable online campaigns to raise funds for those in need. We have to be extra vigilant that the funds that are moving in and out of these new world pathways, is what I'll call it, is safe and secure. So we keep our eye on the traditional ways money has moved, but there is a whole world of new pathways, and transaction monitoring has become much more relevant for us.
So thank you so much for your insights, Stephanie.
I look forward to seeing you in person as soon as it is safe and possible.
Excellent.